How does the Volcker Rule change the definition of a bank?
If the core definition of a bank is a company that takes in deposits and makes loans, what the Volcker Rule does is it says you have to go back to that. In other words, we want you to get rid of proprietary trading. We don't want you to get involved with private equity. We don't want you to grow too big.
Is that a bad thing?
I think it is, because what the Volcker Rule does is it recreates S&Ls. It creates companies which are funded with capital and deposits who put their money into, I'm going to call them plain vanilla loans and highly liquid assets. And what happens to these companies when interest rates rise on a persistent basis is that these companies fail.
If you don't think that the Volcker Rule is the remedy, what do you think is wrong with the system, and how will it be fixed?
Well, I think the problem with the system, for investors is it doesn't generate wealth, right? In other words, these bank stocks are selling at the same price today that they sold at 12 to 15 years ago. In addition to which, we've lost, as owners of bank stocks, we've lost our dividends. So these banks have not created wealth for, the holders of the stocks. So, there is something wrong with this structure, and this structure, doesn't work. And therefore, the question becomes, who's going to change it and how are they going to change it? Now, from my perspective, it should not be the United States government. It should be the shareholders. The shareholders should simply say, look, you're not creating any value for us, so you've got to try a different business model, and the business model has to be breaking up the bank.